Here we go. So people can start. Yeah, Ashley's are 10, 8, and 4. And she is one of the craziest mamas, I swear, on the face of the earth because, when you have 3, you don't have Pete and she don't have the hands covered to cover all of them anymore at this point. So,
Yeah,
but
you're outnumbered.
yeah,
Sure.
yeah, outnumbered,
Yeah.
outnumbered, and they can outrun you. Yeah. All right. And Ryan, 11, 3, and 1. So, it's
Ooh.
like everybody on the TMC, we went through a baby streak a couple years ago. Thanks for joining us, everybody. Where I think that I was missing a member of my team for over a year and a half, because we had 6.
Just back to back. Yeah.
Everybody, when one would come back into the office, another one would go out, and we had a rash of babies within the TMC family for a period of time there. So yeah, it's gotten a
Yeah.
little normalized now.
Yeah, we went through some similar bouts here at Fairwinds as well, where it was just like there was always someone on maternity leave, sometimes multiple people on maternity leave at the same time.
Yeah. Yep. When it happens big, I think. Well, let's
Yeah.
get started here. Thanks everybody for joining us today. This is the Last Week in Mortgage Today. I'm Faith Howard Mooney, SVP of Member Engagement at the Mortgage Collaborative. And joining me today is like a relatively new member. I'm like so excited that you would be willing to do this. Is Dan Felix, VP of Mortgage Services at Fairwinds Credit Union. And Fairwinds joined us in February, at the end of February, just this year. So you've been in about 7 months. I'm so excited that you would do this. I would love for you to just share who Fairwinds is, kind of your geography, and just give everybody in the audience kind of a basis of learning who you are.
Sure. Yeah. So Fairwinds Credit Union has been around since 1949. We started out as a naval credit union. We've been through several different iterations of names as we've changed who we serve in terms of our membership. Now we're more of an open member credit union, a community credit union who can serve just about everyone. We primarily deal with our members here in Central Florida. We are locally out of Orlando, and we serve really the 5 Central Florida counties is where our core market is. However, when it comes to mortgage lending, in the last few years, we've definitely been expanding our borders beyond Florida, and now we're like in 17 or 18 different states across the nation.
Yeah.
So we are definitely growing. I'd say you call us a mid-sized credit union. We have about $5 billion under assets under management. And we have really rocking and rolling with the mortgage business that we've been doing. I would say in 2015 is when we, probably like everyone else, where we started seeing like the big increase in business. We're doing a ton of home equity business right now, which is the nice, advantage that we have as a financial is that we can, when the pendulum swung and that first mortgages got cut off at the knees, we started doing a lot more home equity business. And so that's been keeping us busy right now in this down market. And so I'm definitely blessed to have that. I would say portfolio most of our loans right now, we are a direct seller servicer with Fannie Mae. We're probably selling about 20 to 25% of our production currently, and we're portfolioing the rest. We have some great specialty programs that really help our members with the affordability crisis that we're seeing right now, make their home payment a little bit more affordable, whether that's reduced PMI through our portfolio programs or in some cases no PMI. And so, yeah, we've done a lot to just try to stay relevant over the last few years, that's for sure.
Yeah. So question in the chat already for you is, how does your comp plan for work with your HELOCs? Is that something that's run through your LOs, or can you share just a little bit about
Yeah,
that?
no, absolutely. So basically, what was it in 2022 is when HELOCs just went crazy. When rates started going up, obviously, that's when our HELOC business took off because the cash out refinances dried up. And so up until that time, we ran all of our HELOCs through our just our MLOs. But then it got so busy, that line of business, that we decided to form a team of what we call HELOs, who are just HELOC loan
Uh,
officers.
I love that.
Yeah, yeah. And so now we have 2 teams. We have we have 3 teams really, but one of those 3 teams is our HELOs. They work here out of our call center. They literally sit like right on the other side of this wall right here. And they help service our members through a call queue. People call in and get them, or the branches, when the branches want to make a referral, they call into the Helo. The Helo picks up the phone and takes the member's application right there and then. In terms of the comp plan, to answer your question more directly, we do pay them a base salary, and then we pay them based on units. So, for example, just to make numbers up right now, if their goal was 20 units per, let's say, in a month, then we would pay them a stip based on how much they funded above their goal of 20 units. And so they have a tiered incentive plan as well as a base salary.
Yeah. On the referring in, a traditional mortgage loan officer, is that just, it's part of the credit union, that's what you do as a product, or is there something that they get back on their end for doing that referral?
Yeah, so the branch network has their own incentives that they have to refer business to our call center, because we did centralize back, I want to say in 2017, so that we brought in all the mortgage folks here in the office instead of having them spread out throughout our branch network. And yes, while I'm not super familiar with how their comp plan works at the branch network, I know they do receive something for referring businesses, and each branch has their own set of goals for how many mortgages they refer in, how many HELOCs they refer in, and also our other products such as like consumer loans, credit cards, auto loans, things like that.
Cross-sell, yeah, opportunity for your members that you have in your network. Well,
Yeah.
fabulous information. Thanks, Kelly, for a great question. We always love that. I mean, if anybody else has any other questions, just throw them in the chat and we'll try to pick them up. Appreciate you doing that. I thought since I was thinking over the weekend, I thought since I had you on the phone and you're from Florida, hot topic in our industry has, of course, been homeowners insurance. So on Friday, the California Department of Insurance gave Allstate, which I know that they've been like hiding this, Allstate permission to increase homeowners insurance premiums by an average of 34.1%, which is the largest rate hike that's been approved of any major insurer in the past 3 years. I know that's impacted you. Obviously, you're, a lot of businesses in Florida impacted you as too. I would just love to kind of hear your take on that, as well as kind of what you're seeing.
Sure. Well, California, like Florida, is, a major disaster area when it comes to homeowners insurance. It's one of the riskiest places to underwrite homeowners insurance. And so it doesn't surprise me that they're about to see some hikes. Especially once you consider that, at least in Florida, one of the problems that we've had over the last couple of years, now this is starting to actually turn around, but one of the problems we've had is that we've had a rash of homeowners insurance carriers leave the state. And so I think just, the government's response to that here in Florida has been, well, we have to start allowing them to raise premiums a bit, because if you have too many people leave the state, well, then people are going to have a really hard time finding insurance, which is something that I see firsthand as a lender. In fact, I would say a very large portion of the requests for HELOCs that come through our pipeline are for people who are trying to make enhancements to their house to actually qualify for insurance. Like they'll get a letter from their insurance company saying, hey, your roof is more than like X amount of years old. And even though it's perfectly fine, they're forced to replace it. Or you have a water heater that is, 13 years old. We're not going to insure your property anymore. And so they're starting to crack down. And I know I've been canceled, I want to say myself, at least 2 times, maybe 3 in the last 5 years. And it's not because I'm making a bunch of claims. It's just because they're getting really, really picky. And mostly canceled because my insurance company has been leaving the state. We had, when Farmers Insurance left the state here, they announced it a year or 2 ago, and the last of the policies are starting to go through right now. That put a lot of weight on our on citizens policies. You know, the state insurer that provides they're like supposed to be the insurer of last resort. And I believe at one time they had up to 50% of all insurance policies here in Florida. And
Oh
so
my gosh.
it's not sustainable. And so something had to be done. And so they made it so that the insurance companies could be a little bit more competitive. And as a result, what we're seeing now is we're seeing more insurance companies enter into Florida.
Okay.
Hopefully the competition will bring those prices down, but for right now, prices have not come down. I'm
Yeah.
paying about 300% more in insurance today than I was about 5 years ago.
Wow.
And so, yeah, I mean, it's like, the old adage, I think Thomas Sowell said, there's no solutions, there's only trade-offs, right? And so if you want cheap insurance, artificially, great, but there's only going to be a couple of providers. So therefore, if you want more competition in the market, you have to allow them to raise the prices. And I think that's what California is seeing that they have to do now, what Florida just had to do recently.
Right. I mean, I would tend to agree. I had just not in my mind thinking about that an insurance company would potentially decline somebody because of something, I mean, something normal, I guess,
Mhm.
that was involved with your house, right? I mean, people file claims a lot and those types of things happen. But like looking at the age of the things in your home and then declining somebody, and then that in turn that then drives home equity business is just something that I would have never thought of that would happen. So that's very, very interesting that you've kind of seen that happen. I think everywhere. I'm in Minnesota, so I am not anywhere near, knock on wood, a disaster. I mean,
Right.
we've had some really weird storms around here lately, that have been super bad. But on my insurance also, I think everywhere has went up to kind of like compensate for some of
Mhm.
those places, especially in places where the insurers have not been able to raise a premium. Then
Mm.
they've got a choice to make. Either they're going to offer those at their standard or their normal, what is normal pricing now, or they're going to leave your market. Because if they can't
Right.
lose money, I mean, they're just
Right.
like mortgage lenders, you can't lose money on every transaction. Why you have to stay in business?
Right.
Um,
Right.
we,
They're not the March of Dimes, right? They're not in there to
yeah, yeah,
yeah.
they're not a nonprofit,
Right.
by any, and then it's like the same as what's been going on in our industry is you can't continually just lose money. You have
Right.
to you have to find a way to figure it out. So there's obviously a lot going on. Great to get your take on that. You'll also be joining us in Denver. Uh,
Yes. Will be.
and just we'll actually get to see each other in person in less than a week here. So that will be awesome.
Yes, I'm super excited about it. I'm actually bringing my wife along with me to Denver. It's her 45th birthday. And so I felt bad that I was traveling on her 45th birthday. So I was like, hey, you want to come with me and we'll make like, a fun little event out of it.
Fantastic. Fantastic. That's such a great thing to do. We have a lot of people that there are a few that I can think of right off the top of my head that their spouses come with them quite frequently, and they've
Mhm.
just become part of the TMC family as well. So you might want to
Awesome.
prep her for that one, that she's going to have this whole big family in mortgage instead of just you after she leaves. So that's fantastic.
Yeah.
Other stuff going on in the industry. NAR settlement was 817. I'm just asking people as I talk to them, like, what have you seen happen so far? Because I think it's an ongoing, it will be an evolution
Yeah.
of things. What have you seen in your marketplace so far?
Yeah. So it's pretty early on, right? It's only been a couple of weeks. So we haven't seen um, a big to do about it one way or another. We've spent some time preparing all of our teams, our operations, our underwriting, our originators of what's to come, what to expect when it rolled out on August 17th. We have to start now asking for those buyer's agent agreements
Mhm.
to ensure we have the who's paying what part of the commission properly. We've put together a list of FAQs for our team, which we've gotten from actually help from other lenders to put that together. And so far, it's been much ado about nothing on our end. However, I will say, like just today, I was dealing with an issue where there's a discrepancy between what the buyer's agent agreement says, who's paying the commissions, and what we're being told by the realtor and the buyer. And so we're trying to work through that because they have to close here in a couple of days. And we're trying to get the right addendums in place so the language is right and we know how to disclose property on the CDs. And so it's interesting just navigating all the little nuances of like, where do we have to disclose this on what line of the LE, what line of the CD, how do we balance with the title companies and whatnot. So it's just a learning thing. I think once we're 60, 90 days from now, and we're looking back in hindsight, we might be saying from a lending perspective, oh, that was much ado about nothing. It was some, little kinks that we were able to easily figure out. But our realtor friends are sure going through it right now. It's pretty interesting. Some of the things I've been seeing pop up, like those a la carte realtors who are saying, hey, I'll handle part of your transaction. You can pay me a flat fee instead of the normal 3% commissions or whatnot. And just today, I was reading an article on the Housing Wire. It was pretty interesting. From the what is it? The Burnett Sitzer, lawsuit that started this everything.
Yeah.
The guy Stitzer started a company now offering services, kind of like a brokerage, to deal with the fact that buyers. So he's profiting from his own lawsuit because he's offering the services that are no longer that were lost because of the lawsuit. And so he's essentially wanting to be an online broker representative for these buyers. Now he's saying explicitly he's not a broker, but the services he's offering basically fills the void left by not having a buyer's agent. It's pretty interesting stuff.
That is very interesting. I wondered, it's like one of the things, and I haven't heard anybody say this yet or see it a lot. I wondered if a lot of people would become more like a la carte in what they're offering the borrowers, because maybe they love one piece of the process of being a real estate agent, but they don't love all of it. So, I'm going to be the person that I want to be the negotiator on your contract, or I'm like, I know every house in this market that's on sale and I have great relationships out there. So, but I just want to show homes. I wondered if that, if that was gonna start to happen and we would see some of those types of things.
Oh, definitely. I'm seeing it like, hey, you want me to show you home? It's $50 per house that I show you, or it's like $1,200 to write up your contract and negotiate on your behalf, but I'm not doing anything else. Or like, if you want the full package of the normal buyers, agent services that you would got pre, lawsuit, well, then you're gonna make sure I get paid at least 2.5% commission or something like that. Yeah, so it's pretty crazy.
Yeah. Do you think, and again, another question that I always ask anybody when we start talking about this, do you think that this will cause commissions to go down? Or do you think it's just a different way of displaying those and they'll end up kind of being almost the same as what they were?
Yeah, it's early on, but so far the data has shown that commissions have been compressed.
Yeah.
And so I believe right now in all except for one market, and I don't remember what that one market was, and every market except for one market, realtor commissions have gone down over the last several weeks. And we have a little bit more than just 2 weeks of data because, as you're probably aware, there were several places that started this early, and a lot of brokerages, just started the new agreement early so they can get ahead of it. And so we have seen that the average commission now, I think, has gone down to right around 2.5% for an agent, whereas before it was closer to 3%. It was like 2.75% or something like that. Yeah. So we'll see.
Question in the chat, would you be willing to share your FAQs that you have? And to clarify, they're asking if you are talking about you're asking for buyer's agents agreements.
Yes. Yes. And yes. Absolutely.
Okay.
Happy to share that. If logistically, if I just email them to you, you'll get them out there.
Absolutely, absolutely. And for those of you that are attending Denver, Ashley was so kind to put in the chat that Dan is involved with the homeowners insurance actual session at our conference that's on the 9th at 3:15. He, Emmanuel St. Germain, who is also in Florida, as well as Tony Farnsworth, will be involved in that discussion. So for those of you that are coming with us, please plan on attending that session. Another Florida, I mean, typically we think of as Florida, something that you guys have a lot more experience in working with than other markets in the United States are condos.
Ugh, yeah.
Reaction when you say condos. Tell me what's going on and why we've heard from our whole entire network that people are really struggling with condos.
Yeah, condos, especially Florida condos, are going through a transition right now where I think you're going to start seeing some major price decreases personally in the condo market. At least in Orlando, which is the numbers I track closely, I've seen a big uptick in condo inventory, much more. And you can say, yes, there's inventories across the board in Central Florida, but not as much as condos. Condo inventory has nearly tripled over the last year.
Wow.
And I think so there's several reasons for that. But one of the big things, that happened after that collapse down south of that condominium is that new regulations were put in place about what kind of inspections need to be done and how the HOAs need to now maintain the infrastructure of those condos, especially on the high rises, but really across the board. And so what you're starting to see now is that condos, HOAs can't afford these major repairs that they need to make. So they're doing these special assessments. And sometimes these special assessments are so much that they're, in some cases, more than the people have paid for the condo. I'll give you one example. There was a special assessment. I forget the name of the condo community, but it was down south, I believe. It was a $14 million special assessment. Well, even if you spread that $14 million across all tenants, it was like a $104,000 special assessment for each owner.
Oh my God.
Right. So could you imagine just getting a $104,000 bill out of the blue one day? I mean, and how devastating that is to that condo market. So then what happens then as a result is those homeowners saying, well, I don't have $104,000 and who the heck is going to give me a $104,000 loan to pay a special assessment, unless I have the equity to do a home equity loan. And so what's happening is then they're listing their homes on the market, their condos on the market, and they're trying to sell them. But if you're a savvy buyer who has a good agent, and they do some research, they'll know that, hey, that $200,000 condo that they're selling is going to come with a $100,000 special assessment that you're responsible for immediately. And so you're really paying $300,000 for a condo. So what's happening then is that they're saying, no, well, I'm going to submit an offer for $100,000. And so,
Oh, gotcha.
yeah. And so that's bringing the comps down, right? The prices down. And so now that's an extreme example of what I just outlined, but that's just like a taste of, I believe, what we're going to start seeing over the next couple of years. And I don't believe it's necessarily a long-term problem. Because it's specific to condos, the way I understand it anyway, is that it's specific to condos who are coming up on the 30-year mark when they've been around for about 30 years. That's when these standards come into place. And so if you're a condominium complex that's say 26, 27, 28 years old, you're preparing for that 30-year mark. And that's now you're dealing with all these special assessments. Whereas if you're like, maybe 10, 15-year-old condo, you have some time to maybe raise your HOA premiums gradually to get prepared for that. It's not going to be as a big shock to the system. And
Yeah,
so
I was going to say, so one of the things that those HOAs need to have then after that, not only do they have to do the repairs necessarily, but then they have amount of reserves. So it's kind of like a double whammy where you're having to do the repairs and collect for the repairs, but you also then the HOA needs to have reserves in order to cover those other things that are going to happen in the future, is my understanding. So it's almost like you're getting hit twice, all
yes.
at one time, versus having the luxury of, having an increasing HOA fee.
Oh yeah, we've seen, because we do a decent amount of condo lending here, and we try our best to do it conforming, although we end up having to port a bunch of them because the HOAs don't have the necessary reserves to be conforming. And when my underwriting team is looking at these budgets, we're just blown away by how they just have no money. They just they really rely on these special assessments. They rely on homeowners paying their monthly HOAs on time. And as calamities arise, they don't have the insurance needed to cover these, disasters. A lot of them are going to not replacement coverage for their master policies, but they're doing more cash value policies. We're seeing the master policies fall under. So there's a bunch of things happening right now that's making the condo market very unstable. I am optimistic that people will figure it out in the next couple of years, but I would say within the next, I don't know, 36 months, it's a risky proposition.
Yeah. Well, and I think too, one of the things that we've heard about, within the members of the TMC family is one of the things that we've heard about is people having a more difficult time getting the documentation back that they need to understand what those items are from the HOA. And so it's like now you're very dependent upon those HOA docs sharing with you what is really going on at those properties in order to ensure that people are making a good decision, or you need to counsel them on making a good decision and understanding all that, and then to get your loan approved.
Yeah,
Um, that we've seen
absolutely.
a lot of people having a struggle getting the docs back that they need so that they understand what's going on within that condo and what the risk really is.
Yeah, and we've had a mixture of reaction from borrowers when we, tell them why we can't necessarily approve their loan, in this condo complex. Some are very, angry about it. They're like, well, this is my decision. I should be able to purchase this. Just give me the loan. My credit's great. And then others are very thankful. We actually had an employee here at the credit union who applied for a condo loan, and we just shared our research with this person. And, we're like, I'm not sure that this is like in your best interest to do this. And they were so happy that we were able to give that information to them and show them exactly what we were looking for within the HOA budget. Also on the condominium questionnaire, as my underwriter manager will point out, oftentimes there's safety and soundness concerns on the questionnaire that need to be addressed. And it's like, do you really want to buy into that right now?
Yeah. Well, yeah, you're protecting them. I
Yeah.
mean, it's like you're protecting them. That's when gratefulness should always should always come out. Huge financial decision, and somebody is gonna share that with you. It would be. I understand the emotional process of
Mhm.
finding a home right now, especially, and the number of homes that are out there available. But yeah, that's where gratefulness should definitely come into play. I typically have during these calls, I have like a phrase of the week or something that I found that I love the helos. That one's going to stick with me for a while. I love that one. But the other one that I saw, and I actually saw it on a morning news program this weekend, what it talked about the uncommitted consumer.
Mhm.
And it's like, I guess I've never really thought about this much, and it doesn't. I'm wondering if it like falls over into home ownership kind of as well. But the how they were talking about it was in reference to consumer spending. So it
Mhm.
was referencing people are no longer committed to that loyalty card or that one store or a certain grocery store. Instead, they're shopping based on dollars that they have to spend, and so they're trying to find the best deal that they're getting. So they're going to multiple grocery stores. So when it's your grocery shopping day, instead of going and buying things at one store, you're going to buy this from this store, this from this store, this from this store, as an extra effort in saving money because of the high cost of goods. So when I was thinking about this, I thought, number one, I've never thought about that because I guess I've always kind of shopped in that way a lot of the time. So
Yeah.
I don't know, it's always kind of been something that I've done personally. So I didn't really think that other people just wanted the convenience, go to one place, get it done, get in, get out of there. buy it online, drive up in your car, pick it up and leave. But apparently they're seeing in some of those things that people were doing that during COVID. Now they're reverting to not doing those things anymore. And I wonder if there's any, sense that you have that those same feelings with the market being as tight as it is, with rates being where they are, and everything, that people are kind of sitting back, maybe more in waiting on the bigger ticket items like a home as well, and saying, I'm just going to wait this out. I've changed my behaviors. I'm going to wait this out until I can find exactly what I want, where I want it, and then I'm going to go after it. What do you think about that?
Yeah, so I have several thoughts about that. So when I think of the uncommitted buyer as it pertains to the real estate market, I think of how we've seen how uncommitted they are in the last few years in several ways. Whether you call it uncommitted or unloyal, but however you want to phrase it. But especially now with the new NAR agreement, I think people are going to not just default to using their cousin who's a realtor all the time. They're going to shop around, see who they can pay the least for their realtor services now that it's coming out of their pocket, right? As a
Right?
buyer. I think what people are even uncommitted to the contracts they signed nowadays. Right now, and this problem is especially bad in Orlando, where I was reading that 20% of all contracts are falling through right now. They're falling through possibly because the inspection error in the inspection time, or they're falling through in some other way because their agent is trying to wiggle them out of the contract because they're having cold feet. They're getting buyer's remorse. They didn't realize their payment was going to be so high. They didn't realize that homeowners insurance was going to be that high or taxes are going to be that high. And so they're getting cold feet and they're dropping out of their contracts at a rate of about 20% in Orlando, which is one of the highest in the country. But I bet you it's probably up nearly everywhere. And then also when I think of being uncommitted, I think to the mortgage lender who sends them the pre-approval as well. What we're seeing, I was talking to a mortgage broker the other day who told me that it used to be and he was a little bit older, so he's been very seasoned in this industry. And he was saying, it used to be that out of 10 people who called me for a pre-approval letter, I would end up closing 9 of them. Now it feels that it will take me 10 phone calls, 10 different contacts, 10 different pre-approval letters to close one single mortgage. And it's just a shift in mentality. And I can't fault the borrower for it. I mean, they're just shopping out for their best interest. That's what they're supposed to do.
Yeah.
But the industry certainly has changed in that way.
Yeah. Yeah. This has been the greatest conversation today. I so appreciate you. We are out of time. I
Okay.
told you it would go fast. And so
Yes.
already at the bottom of the hour. I cannot wait to meet you in Denver and your wife. Great conversation today. Please come back and do this with me again. You have been a great source of information. And just a nice conversation to be able to sit and have on this Tuesday afternoon after the holidays. So I appreciate you, Dan, for doing that.
I
And
enjoyed it, Faith. Thanks for the invitation. Can't wait to see you in Denver as well.
I know. And for everybody else, we will not have the last weekend mortgage today next Tuesday while we were at conference. So we're going to take a week break while we're there and take that time off and spend it enjoying the people that are there with us. I hope you're one of those people. If not come back next week, but come back the following week and join us again. Appreciate you, Dan. Thanks so much.
All right. Take care.
Bye, everybody.